the XPRIZE Foundation's Barbara Bush Foundation Adult Literacy XPRIZE webinar series. I'm Ed McNerney, our technical director, and I'm very pleased to welcome Jean Hammond to join us this morning. She is an experienced entrepreneur. She's a co-founder of and partner at LearnLaunch, really knows this space and market incredibly well. It's very generous of her to join us and talk to us this morning about funding sources for EdTech and workplace tech. She will start her presentation. We have the Google Hangout Q&A app open. So if you do have any questions, please just type them in. We'll be able to track and manage those questions, and then we'll go through them with Jean at the end. So with that, Jean, I'll hand it off to you.
Okay. Well, thanks for asking me to do this. I'm increasingly excited about the opportunity for workplace tech, and think that the XPRIZE in this category is really, really exciting. So, I've had numerous backgrounds and many, many years as an angel investor. You'll see I'll talk quite a bit about angel investing as one of the ways we fill some of our gaps in funding sources here. But increasingly, there's many, many things going on in funding. So it's kind of a fun time to dig into this with you. I'm sure it's going to feel overwhelming. So we can take quite a bit of time for questions if you have them, or some of it won't feel that relevant, but we'll see how it goes. So really, we're going to look at funding sources, really try to understand how the funding sources can match up with the correct with the companies. It's really a story here about don't try to talk to the wrong person about the wrong thing. And so if there's an investor whose business is finding a certain class of company, and you're not that class of company, talking to them isn't going to provide you with much more information on how to get to the sources that do fit you. And so really, this is really to help you kind of sift through all those buzzwords and try to figure out what's going on. We'll spend some time on all the different funding sources types. We'll dig in a little bit on EdTech market, EdTech funding and what's been going on there. And then talk briefly about what investors want to know. But the next webinar I'm going to do in this series is going to be much more in depth of the, how to get the meeting, how to make sure that the first meeting is the right meeting, and much more detail on what investors want to know. So I'm sure you'll find that part of this presentation is very lightweight. So here's the 10-second advertisement about LearnLaunch. So LearnLaunch has 3 different types of operation. Our institute does events and conferences, and some other ways of bringing together the community. Our last big conference had about 900 people at it back in January, and we expect another one about a year after that. And we do little training classes, helping people figure out details about being an EdTech entrepreneur, or bringing the community together to discuss different issues in the community, everything from what's going on in K-12 privacy to, how are higher ed companies addressing finding the right students. And for us, education includes what everybody on this who's listening to this session is doing. From our perspective, education is everything from early stage, from early childhood learning all the way through anything that people would do to improve their chances of getting a job, and moving ahead. So to us, all of that is EdTech. The Institute also has a small Gates Foundation grant where we work with some of the inner city Boston schools on digital learning, and we also work with some innovative superintendents here in Massachusetts. The accelerator is a application equity style accelerator that brings in companies into small 7 or 8 company cohorts, and puts them through that 3-month boot camp. We also have a breakthrough program for more mature companies to come in for less time. Our campus is a co-working space here in Boston. We just moved over to the Fort Point Channel. So we have about 35 companies that have decided to rent together and learn from each other in that setting too. It's a great environment. If you're ever in town, be sure to stop by. We'd love to see you. So enough advertisement about Learn Launch. So really the point of this slide, which is a very busy slide, so we're going to definitely slow down and spend a little bit of time on it, is to point out that there's really a lot of different kinds of companies, and that entrepreneurship comes in many forms. There's actually no bad kind of entrepreneurship. There's just entrepreneurship that doesn't fit the flavor or the investing interest of various kinds of potential investors. And so, to address that, we've tried to put together sort of a way of thinking across the scope of these companies. So I'm actually going to start with the normal growth companies. Really, this is the heart of the world, right? This is everybody who does a service or makes a product or runs a store. This is what business basically looks like. And in many cases, when you see it as a startup, it will be either a service business or exploiting a local market need. In general, the team has great jobs. And again, when it's a startup, since we're always focused in on growth, the growth is mostly happening by adding resources one by one. And if and when there is an exit, it will be based on the cash flow value of the business. So focusing back in on that growth aspect, it's really a story about, as we need to do more of this kind of work, we hire 2 more people to do that, and then we do that kind of work. So there's no unusual scaling characteristics. So jumping over to high growth companies, what we start finding is that these companies, for one reason or another, can scale faster. Maybe they're doing some things that are online. Maybe they have lower cost ways of delivering something. But in general, it means that they can grow faster than an ordinary business that might need to develop its services, its customers, and its capacity at the same time. In a high growth company, the faster you can develop customers, the faster you can satisfy them. So again, because in a startup world, the team is often motivated by the potential of an exit, and an example of an exit might be a capital efficient company that had brought in some angel or angel group funding, had grown up into the $7 to $10 million revenue stage, and then was able to exit by mergers and acquisition to a larger firm that had the next thing they needed, maybe a sales force or something, or different kinds of capabilities. Extreme high growth companies are what we read about in the paper all the time. This is where the venture money goes. And so these companies have some reason that they're ultra scalable. In an Instagram world, you don't have to pay anybody to make those Instagrams. They're making them and sending them to each other. And if you can figure out how to monetize that flow, you have a business that there's no limits on its capability of scaling. And so when we talk about the venture-backed world, the venture community is digging in a very large haystack looking for a needle that looks like an extreme high growth company. And so they're really looking for companies that can, take in substantial amounts of money, because the VC has to move the value of their fund with their investment, and therefore they need to get a lot of growth really fast and then be able to exit into an IPO or a large merger and acquisition event. And so really this is a story about companies that can grow really, really fast, get up to big chunky revenue, and in the past exited. Now that we have this thing called unicorns, we're not quite sure what to think. So let me go back to social ventures, because I think that what we're going to find on the people on this call is that we're going to have a mix of social ventures, some of which have some nice high growth company attributes. So this is really the story of a goal is to fulfill a social need, has a mission orientation, and the team is there partly to support the mission. If they've got other, if it can grow quickly, then they may also be looking for exits once the way of growth has been proven. It may be able to be scaled to other environments, and that might be very attractive. So if the company is truly a service business, then it may be harder to find an exit. If it's some blended company that has high growth attributes, digital delivery of a learning product, for example, but also has a mission, then it may look a lot more like a high growth company. And a few companies in the social category will come in the extreme high growth category too. But that's just part of the story. So I put this slide up to try to show some of the possible types of funders that might be interested in different types of players. And this is another point to repeat that statement I made before, which is, funders come in flavors. They're out looking for something that matches their taste, and they're not going to change their investing philosophy based on meeting somebody. They're going to be continuing to invest the way they invest. And so really your job in this whole mess is to find the ones that fit you, not to just talk to anybody who happens to be moving money into early stage companies. So one of the questions you need to ask yourself at the beginning is what type of company you are, because there's a mix of aspects of the type of company, not only the business objective, which is part of what we just talked about, but also the business model. Because some companies, the business model will have a big impact on how much and what kind of money it will take to cause business growth. So, is this a SaaS software company? Is this a company that has the cost structure of enterprise sales, selling to different entities one by one? All of those things affect how much money you need, at what stage you need it. And so it's part of the conversation with the funding source. Sometimes you get to choose. You can say, hey, I have this neat new, battery technology, and I can go anyway from being a battery company that licenses it to somebody to building a factory and building a bunch of batteries with a bunch of different steps in between. And the funding sources that are interested in that company are completely different based on that selected business model. So you need to be focusing in on that too. And every company's path is unique. We see people having to string together an amazing set of different paths, and the financial players are specialists. So most of the funders in the world operate by the same rules of the road, which means they like to be introduced to people. So one of the things that you'll find is, in many cases, you're going to need an introduction to get going. So this slide that I've just popped up now is designed to give everybody a really big headache. But in fact, that's what we actually see out here. We see this kinds of number of different possible places that somebody could find funding to support their venture. And in many cases, people are putting together a mix of these. You know, somebody's going through a small personal loan, they're getting some grants or some type of something like that. Then they're off to an accelerator. Pretty soon they're over at a micro VC or an impact player of one of the equity types or one of the debt funders. So all of these types of players are part of the possible path that somebody might go through. So I'm going to spend a number of minutes running down through slides that have too many words on them. Do what I say, few words on your slides when you're presenting to investors, not what I do. And just quickly covering all these different things. I'm going to have to speed it up to get through them all, so we'll be going kind of fast and just getting the high concept. So debt capital, it's obvious, it's a loan. You're going to have to pay it back. Traditionally, this was this story of this, hey, the minute you take out the loan, you have to start paying a principal and interest payment every single month. And you couldn't even get the loan unless you could make a personal guarantee or had some assets. But recently, impact players have been developing completely new debt instruments. And so where this slide used to be very short, it's now actually quite long. So really interesting to have debt instruments for cash flow based businesses that are never going to have a appropriate equity exit to attract equity capital. There may be long, quote, no payment periods at the beginning where, hey, it's startup capital. You have to use it to get started. And then eventually a system whereby royalties click in and those track revenue. And royalties that track a revenue source is a great example of something that that appropriately addresses things like any kind of seasonal seasonality in a company's business model that may be hard to explain to a different type of debt holder. Clearly down here at the bottom are some various kinds of new venture debt, new specialist debt, and certainly there's some impact debt and impact bonds for big solutions coming on. Equity capital, this is the stuff that people are always thinking about. Hey, it's the VCs. Oh, I guess there's this thing called angels. And increasingly, we now have various classes of impact players who are playing in a mix of VC and angel roles. And in general, when you're in equity capital, you and your investor are going to be looking eventually for some type of exit. VCs are investing some pretty substantial dollars. Historically, it's been closer to 25, 26 billion, but people rarely get the fact that angels are also in the 25 billion range and provide a lot of capital in here. So one class of capital that kind of crosses 3 or 4 of these different types of investing philosophies is the impact capital. There certainly are over $60 billion that are in funds being managed, and at least 10 billion being added each of the last 2 years. It should say each of the last 2 years. Most of the funds are pretty late stage funds. They're or maybe I'll go ahead and do this point first. So about half of the funds are private equity or venture capital. Private equity is late stage money that's doing some type of exit based equity investing, as well as the VC. And they make up about 49% of the impact funds. A lot are using fixed income instruments, so they're basically looking more like debt. And others are using multiple instruments. And probably about 20% of these private equity and venture capital funds are targeting North America, and so they're ending up moving perhaps as much as $5 billion a year of money into categories that we will find comparable to the angel and VC types of dollars per year numbers that we usually look at. So obviously it's a new and complex space. Spend a couple minutes on crowdfunding. Crowdfunding has been going up pretty fast. The rewards-based crowdfunding has leapt into the well over $11 billion a year kind of category, and the equity crowdfunding is coming along. AngelList and CircleUp and other types of crowdfunding that use accredited investors, just like the other angels, are now reaching, certainly over a couple hundred million a year. The Jobs Act or the Jobs Bill portals will come online on April 25th, I think. Anyhow, sometime within the next month. And these are designed to allow ordinary human beings who are not high net worth individuals, such as participate in AngelList, CircleUp, or all of the angel investing categories. They are designed to let those people invest. Unfortunately, the SEC has come in and put some very, very tight controls on this category. And so it's unlikely that we'll see this type of equity investing probably mingle with other equity investing from angels or VCs. It's capped based on the person investing's income, and the portal that is going to manage the deals has to maintain the records forever. And so people are thinking that this may be as high as, tens to $20,000 a year of record keeping requirements, which may not be appropriate if in fact this was a really small entity that just wanted to raise some money from their neighbors to get that local business started or whatever it was going to be. There certainly are now increasing types of debt-based crowdfunding, the Lending Club and Prosper.com. So obviously, if you're willing to take the kind of interest rates that these folks are putting out, there's ways to do that. And there's some types of, and there's donation-based crowdfunding. Certainly there's hundreds of different sites, many of them focusing on a special category, looking for donations. Philanthropy and foundation funding is clearly a category that's interested in the types of work that are happening in pursuit of the XPRIZE. Individual philanthropy can be a gift or tax deductible. So I'm not a lawyer and I didn't play one on TV, but the smaller nonprofits can often help if somebody wants to give a tax deductible gift, and you can do some services for that entity as a way to help make sure that that you can get to some funding, if everybody's needs are met appropriately. Foundation grants are clearly a place where many people on this call will probably have more knowledge than me, but it's a place where the theory of change and how to measure your results against theory of change have really moved into the norm. So instead of just operational-based grants, people are much more interested in seeing what's going on. We also see the foundations out making investments, and so this so-called mission-related investing is a new type of activity that many groups are now trying to figure out how to make work. Sometimes they'll be doing that through investing in impact funds or in impact types of operations. In other cases, they may do direct investments. That will be, you'd have to really know that foundation quite well to be able to get in on that part of the story. But we see lots of the majors, including the Gates Foundation, talking about it, even though they're not doing tons of it yet. But compared to the billions of dollars that are moving in these other categories. Some of these other sources of capital are always great. Business plan competitions often move people along, get them a little bit of capital. Clearly, the best of all is to get some type of revenue source, because then you're not needing to pay back any debt or do any other thing. I always like to point out that people who are in your ecosystem are often a great source of capital. So, if you're selling something that makes somebody else's life easier, they may want to be able to help you out. So it may be that your future customer can give you a prepaid prepaid purchase order, and then that gives you some funding during the dry period, or somebody who's helping you make something can give you the equivalent of a cash flow loan by not billing you for some period of time. There's certainly a lot of grants out there. The government has to give out about $2 billion a year through the SBIR program, and each department has to have a call. So these grants are coming out, and particularly the ones around the categories that are here in the XPRIZE area of interest, whether they're coming from the U.S. Department of Ed or maybe from the Department of Labor. You'll be finding that they'll be focused on either an innovation, a science innovation, or a theory of change, and then how to measure results on all of those. There's other government funding from states and sometimes even municipalities. So, again, as we look through this hodgepodge of many sources, it's a type of so since I run an accelerator, I have too many slides on accelerators. So really, they've been popping up like crazy. They definitely seem to fill a class of need of providing some amount of support and human capital, both from learning from mentors and other people associated with the accelerator, and also from learning from peers who are in the accelerator at the time you are. And so that's a benefit to the entrepreneur side. When seen from the investors, it's a story about not having to helping the investors make faster decisions. And an example I might give here in Boston is to say, hey, here in Boston we have over 250 EdTech startups. Don't you, as an angel, want to start learning how to invest in EdTech? And they go, ooh, 250 of them. Wow, I don't know how I learn enough. And then I say, oh, but I'm having a graduation of 8 companies that just finished my accelerator. Would you like to come and see what they're up to? and get to know them in some detail, and the investor eyes light up and say, oh, well, that's something I could do. So again, one of the things that accelerators do is provide a selection bias to the investors of kind of what to look at. And certainly industry-specific accelerators are often a great way for strategic partners to interact with the startup economy. The main concept here is that we can add some human capital and some, and that will make the taking of dollars more effective. The next two slides are slides based on this link to a post from PitchBook, a big firm that provides analysis of VC and private equity investing, and so the news here is that 1/3 of all U.S. startups that raised a Series A went through an accelerator, and so whether we like it or not, it's a selection bias aspect. And the next slide is just the slide that shows that graphically, that about 30+% of the companies that received Series A had been accelerator backed. And so, and this probably misses a few of those, a few companies that did get all the way to Series A, because it over-focuses on VC money, whereas some of that money comes out from the angel community that does not report into the VC databases. So this is my slide to graphically talk again about the equity players, the angel and venture capital folks, in a way that gives you sort of an insight of this amount of funding over time. That over these years, there's been pretty steady growth and sustainability of these two classes of equity capital, and this is the point where I always ask people to guess how many investments each of these sets of capital made, and the answer is pretty compelling. Really, the number of deals done by the venture community between 2,700 and maybe just over some years getting closer to 4,000 deals is really a very small amount of the deals getting selected. And again, the selection bias is heavily to these ultra extreme growth companies, and the selection bias is also extremely high to the later stages of the funding. So I have a slide that kind of that if you look where the angel money went, it went into the seed and early stage deals. If you look for where the venture money went, it went into the expansion and later stage deals. And so, and we see this story in EdTech too, even though both of these last two slides have been specifically about angel and venture as total categories. So it's definitely a story about waiting to the later stages. So some of the trends that are happening over in this equity space is that the angel investing continues to be the top of the funding pyramid, and it's complemented by about 60 billion from friends and family dollars. About half of that friends and family dollars does not come into the same class of deals that are angel investable. It goes straight to lifestyle companies. About 30% of the deals go on to get more funding, often to a Series A level. And most are follow-on angel dollars headed toward a mergers and acquisition of exit. Some move into lifestyle companies, and some move into the VC funnel. Increasingly with entities like AngelList providing more funding into the system, more companies are getting that money from angel list and then going over into the VC funnel. So that's a little bit of a change. VCs did 58 billion in 2015, but a significant percent was captured in these giant unicorns. In fact, some people are estimating that as much as $30 billion, well, $30 billion of VC and other private capital are captured in the unicorns. And so that's a big chunk of the VC money too. So it's actually sort of an interesting period. IPOs were quite high in 2014, but they went way down in 2015. And so the average of those 2 years is about 200 IPOs annually, with about 50 billion in total proceeds. So there's a sort of a continued issue happening in the late stage funds. So, whoa, that was a lot. But again, across all those bubbles are a path that any one entrepreneur will probably need to make a path for themselves through. So a couple of minutes on what's been going on in EdTech. So EdTech has really taken off over the last period of time. There was a medium bubble before, but nothing like this. And so really we're seeing tons and tons of venture money dumping into this category. A lot of it is heading, just like the other venture money, to very late stage deals. I mean, lynda.com alone absorbed a humongous chunk of these dollars, and then returned quickly for its investors through its giant exit to LinkedIn. So again, companies that are working in these kinds of categories are finding it easier to find Series A if they've already demonstrated pretty substantial scaling capabilities, and then they're being able to jump around. So I didn't put on an exit funnel in this slide deck because our exit data is a little bit. We continue to see a pretty healthy exit environment in EdTech. The giants with names like Pearson, McGraw-Hill, etc., are continuing to acquire some number a year, usually waiting until the companies have demonstrated somewhere between $1 million and $7 million in revenue, but occasionally buying concepts out of the lab. And so we see a mix of those behaviors. We're also increasingly seeing sort of concentration of some other players, where companies that are just above, maybe their Series A level companies are acquiring even earlier stage companies. And so the exit profile is pretty robust and pretty busy. As we look into the EdTech category as a whole, we see a lot of opportunity around corporate training, some aspects of workplace tech, as we just discussed. We're seeing some pretty decent interest in various classes of special needs. And then eventually we'll see a lot of focus on making the college pathway more efficient. over to careers, high school and college pathways, more efficient. Those investments are just starting now. The other thing we're seeing in EdTech is some use of big data to look at things, and all of the EdTech community is talking about moving toward lower cost products that can address the rest of the world, where the interest in education is extremely high. The U.S. market for education at 1.3 trillion or 1.4 trillion is dwarfed by the 4 trillion in the rest of the world, and interestingly is growing quite a bit slower. So those markets are out there, but they're moving slow. So this is a slide where I've tried to look into the specifics of the EdTech funding gap in the early stage. So as you can see, we have quite a few players in the EdTech accelerator space, doing a range of different versions of accelerators. Some of them are co-working spaces with a small amount of EdTech programming. Others of them are more like the immersive types of accelerator like we run here at LearnLaunch. We've also, and this is actually quite recent, seen a improved funding of and a resurgence of Series A VCs who focus on EdTech. So we definitely have players out there who are who have money and are ready to invest if they can find the right things, who've reached a Series A capability. And we'll spend some time on this in the next webinar, but really a Series A is all about a repeatable business model, having already reached the ability to prove that that if you had another set of money to move to spend on sales and marketing, that you could enhance your revenue by a proportional amount by spending that sales and revenue and marketing revenue. So we found that they've found their money and gotten themselves funded, and they're out there getting ready to do some funding. We have an increasing number of impact investors, and I certainly don't have all of them on here. Partly, in many cases, they're still getting their structure put together and trying to decide whether they're going to look like a VC or they're going to look like a slightly different type of entity. But we have very few players in what we might call a microfund category of really doing very early investing, and so what we find is that the angels and the angel groups are filling this space. We certainly have some players on this slide that we would think of as being highly interested in impact and quite concerned. Ooh, look at the time! And quite concerned about the types of things that the XPRIZE folks are looking at. Certainly, Mars, Investor Circle, and Kapoor across the bottom are all impact oriented. All of the players on the who are named on the slide on the right would claim an impact interest, and some of the traditional VCs will be interested, but in some cases it's a harder stretch. So really, simply put, Are You Ready for Funding is a story about thinking about your stage of development, making sure you fit with the kinds of funds that these different players can put to work. And so again, this early stage prototypes and first revenues have traditionally been the space of the angel investors, with a few rare occasions of microfunds. And later than that, repeatable revenues are headed over towards Series A. Understanding that you have a team, a good understanding of your total capital requirements. So the story that says, hey, I need 500 tomorrow, and I'm going to need something like 10 million right after that, doesn't hack it. You have to think it through more carefully than that. Good understanding of your financials, good understanding of your executive summary, and having your investor pitch ready. Here, very briefly, are the things people want to know, and these are the things that we're planning to cover in the next webinar. So we won't spend a lot of time on it here because I've gone long, but really detailed understanding of being able to dig into telling a complete story that make an investor or a debt issuer being happy to interact. There certainly are some good hints out there for creating an effective deck, and this is just one of them, but there's a gazillion on the web. So that's part. Investing is a complex relationship, whether it be some type of impact debt or other types of investing. This is sort of a contract. You have a deal with these people to do things that you said, and they're finding chunks of cash to help you with that dream. You need to learn to stand in the other side's shoes. Many people can't imagine what it'd be like to walk up to somebody that they met 3 days before and be ready to make a 25K investment in that person's. Understanding some of the details of what it takes to get there is sort of interesting. And people make a big difference. In many cases, the highest value added by the investor is the door they open to relationships, the deals they help you make. And for angel investing, the secret sauce is that human capital, the ability to provide support and advice going through the system. Entrepreneurs of all types are usually interested in helping each other. In any case, in any place where an entrepreneurial community has built up, it's important to understand what those different components are. There may be somebody who can help you with sussing out your cap table without needing to have your lawyer or some expensive accountant help you figure that out. That may be in a class or something like that. Use the rules of the road, get introduced whenever possible. It greases the skids across all the different parts of the system. Look at the range of ecosystems to find a range of investors. So if I wanted to find impact investors here in Boston, I'd probably be over at Greentown Labs, where some clean tech investing is going on. Not everybody in clean tech is interested in other things, but some of them are. And so really sort of think about the ecosystems, and in many cases finding a champion in the investor community and advisor and mentoring community can help with everything. Sorry I ran a bit long there, but I think we have some time for questions.
We certainly do. Gene, thanks. That was pretty impressive. Thanks very much for going through things. I really liked your emphasis. Gene, could I use your microphone? Because I think you're getting a bunch of some feedback here. Let's see if that works a little better. Okay. But I did just want to kind of reflect on your theme about relationships and stuff. I think that's really something that's incredibly valuable in sort of building these relationships. And that's one of the things that the accelerator environment and some of these other environments do. But I was wondering if you could just had a question about when that starts. I mean, there's sort of this old saying, if you want advice, ask for money. If you want money, ask for advice. At what point, would you, if you were a startup entrepreneur, start some of these conversations with angels or with an accelerator environment? Let me see if I can get you unmuted now. You're still muted, so I'm gonna, and I think you need to unmute yourself before you can, before we can hear you, Jean. Should be able to do that right up at the top of the screen on the little microphone icon. While Jean's doing that, I just want to invite anyone else who has some questions. Go ahead and post them with the Q&A app. We do have a question about whether slides will be posted. Obviously, this Hang On Air will be recorded, and we'll be able to watch the entire video, and we'll work with Jean to get the slides themselves available to everyone. And Jean, right up at the top of your Hangout window should be a number of icons with a person and a microphone and a camera. Your microphone's probably red with us. You should be able to click on that to unmute. Okay, looks like we ended Jean's part of the presentation. Thanks very much for the questions. I'll thank you again to Jean for really sharing her incredible expertise with us. She'll be back again, as she mentioned. Please pay attention to the rest of our Adult Literacy XPRIZE webinars. And if you have any follow-up questions, we can certainly get those to Jean and send them along to us at adult.literacy@xprize.org. And Ben Bain and Devin and Shlomi and I will make sure we get some answers. Thanks very much, everyone. Bye-bye.